Hey everyone, welcome back to Corporate Decoder. Today, TAL Education Group just filed its annual report on Form 20F, and I am seeing one massive trend shift that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. TAL's financials show a strong recovery, but a big strategic pivot is underway, and it has to do with how they make money now. Alright, let us dive into TAL Education Group's annual report for the year ending the 28th of February 2026. This is essentially their yearly checkup with investors, and it tells us a lot about where the company stands. First off, TAL Education Group, or TAL, is a big player in China's education scene, offering smart learning solutions. They call themselves a smart learning solutions provider in China. Their whole mission revolves around promoting top learning opportunities through great teaching, content, and technology. They started back in 2005, focused on K-12 tutoring, but things have changed a lot, especially with new regulations in China. This document is a Form 20F, which is basically an annual report for foreign companies that list their shares on US stock exchanges. Like the New York Stock Exchange, it gives a really detailed look at the company's business, the risks they face, and their financial health. Now, you can see right away from the risk section that the regulatory environment in China has had a huge impact. The government has really tightened things up, especially for after-school tutoring, and TAL has had to adapt. They actually stopped offering K-9 academic tutoring services in mainland China at the end of 2021 because of these new rules. That is a huge strategic shift. They have refocused on what they call learning services and others and learning content solutions. Let's look at the numbers and see how this pivot is playing out. The top line looks impressive. Total net revenues jumped from about $1.5 billion in fiscal 2024 to $2.25 billion in fiscal 2025, and then to over $3 billion in fiscal 2026. That is a significant growth year over year. Breaking this down, learning services and others is their biggest revenue driver, hitting nearly $1.95 billion in fiscal 2026. This part of the business grew by about 27% from the previous year. This section includes things like their Shuesi Peiyou small classes and personalized premium services. Then there is Learning Content Solutions, which brought in over $1 billion in fiscal 2026. This segment saw even faster growth, up almost 48% from fiscal 2025. This includes their learning devices and books that come with digital learning features. So, the numbers show growth, but how are they making money? Their cost of revenues, which are the direct costs of providing their services and products, was about $1.34 billion for fiscal 2026. That is about 44.6% of their total revenue. This includes teacher compensation, rent for their learning centers, and other direct costs. The good news is, this cost as a percentage of revenue actually went down compared to the prior year, which suggests they are getting more efficient. Selling and marketing expenses were substantial at $889 million, or about 29.5% of revenue. This is a big chunk, likely reflecting their efforts to attract new customers in their current business lines. General and administrative expenses came in at $500 million, about 16.7% of revenue. This is actually down quite a bit as a percentage of revenue compared to the previous year, suggesting they are managing their overhead well as they grow. The result of all this is a healthier gross profit margin. It increased to 55.4% in fiscal 2026, up from 53.3% in fiscal 2025. This tells us that their core business is becoming more profitable. Overall net income was strong at $530 million for fiscal 2026. This is a huge jump from just $84 million in fiscal 2025, and a big improvement from a net loss of $4 million in fiscal 2024. This recovery is largely driven by turning those operating losses into gains and better management of their investments. Looking at the bottom line, net income attributable to TAL Education Group shareholders was a solid $530 million for fiscal 2026. Bear in mind, this is a big turnaround from a net loss just a couple of years ago. What about their cash position? As of the 28th of February 2026, TAL had about $1.78 billion in cash, cash equivalents, and restricted cash. That is a healthy amount of liquidity. Their operations generated $601 million in cash for fiscal 2026. This shows their business is not only profitable on paper, but also generating actual cash. When it comes to investing activities, they actually used about $175 million in cash for fiscal 2026. This includes buying short-term investments and other long-term investments. The big story here is that they turned from being a net provider of cash in investing activities in fiscal 2024 to a user of cash in fiscal 2026. likely deploying cash into growth opportunities. And financing activities, they used about $643 million in cash for fiscal 2026, mainly for repurchasing their own shares. This often signals that management believes the stock is undervalued, or it can be a way to return capital to shareholders. Now, digging into the business strategy, TAL is clearly adapting to the new regulatory landscape. They are focusing on learning services and others and learning content solutions. This means less focus on traditional academic tutoring for younger kids and more on broader enrichment programs, creative learning, and selling content and technology to other institutions. A critical area to watch for TAL, like many Chinese tech companies listed in the US, is their corporate structure, especially the variable interest entity or VI structure. They rely on these contracts to operate their business in China because foreign ownership rules are strict. The filing highlights that if Chinese regulators change their minds about this structure, it could severely impact their operations. This is a major ongoing risk, as you can see highlighted in the risk factors. The regulatory environment remains a key risk, and they mention significant uncertainties with new laws and policies. This means the rules can change, and that creates a lot of unpredictability for their business. This is why understanding these filings is so crucial. Then there is the ongoing US regulatory situation concerning Chinese companies. Even though the Public Company Accounting Oversight Board, or PCAOB, can now inspect certain auditors in China, the risk of being delisted from US exchanges under the Holding Foreign Companies Accountable Act, or HFCAA, is still there. If the PCAOB loses access again, TAL could face trading prohibitions which would be devastating for investors. On the leadership front, Bangxin Zhang remains chairman and CEO, and Yaka Lu is a director and Ku Alex. Peng is president and chief financial officer. These are the key people steering the ship through these regulatory challenges and strategic shifts. On the legal front, TAL is facing a couple of securities class action lawsuits. One is still ongoing in court, while another one reached a settlement in principle in early 2026. These lawsuits can be costly and distract management, and an unfavorable outcome could hurt the company. The company also flags risks related to misconduct by employees or third parties, which could hurt their reputation and business. This is a common risk, but it is always worth noting. Looking at the financial picture, the company has successfully navigated a challenging regulatory environment to return to profitability and strong revenue growth. The shift to learning content solutions and diversified services seems to be paying off. However, the underlying risk of the VI structure and the broader US-China tensions remain significant overhangs that savvy investors have to consider. The current market cap is around $5.1 billion with a PSI ratio of about 9.9. While the profit recovery is impressive, the stock price has seen some weakness this year, hitting a 52-week low in May with some analysts questioning its valuation. The biggest story here is resilience and adaptation. TAL has weathered significant regulatory storms and appears to be on a solid growth path financially, but the structural and geopolitical risks are always in the background. What I am really watching is how effectively they can continue to innovate and grow their diverse offerings while navigating the complex Chinese regulatory waters. The increased investment in learning content solutions and technology is a good sign, but the long-term impact of government oversight remains the key uncertainty. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Check out the Discord in the description.